You're sitting across from Warren Buffett, the world's most famous investor. You ask him, what's the one book that shaped your entire career? Without hesitation, he says, The Intelligent Investor by Benjamin Graham. Buffett even calls Graham his teacher in investing. But here's the twist. There's one rule in that book that almost every investor today ignores, and ignoring it might be the reason why most people never build lasting wealth. Stay with me, because in this video, we'll unpack the 5 core lessons from The Intelligent Investor, and I'll reveal the single most important principle that Buffett himself credits as the foundation of his fortune. Benjamin Graham wasn't just an author, he was Buffett's teacher at Columbia Business School. Buffett admired him so much that he begged to work for him, even offering to do it for free. Eventually, Graham hired him, and Buffett learned the art of value investing directly from the master himself. Buffett later said, "The Intelligent Investor is by far the best book about investing ever written." And that's because it didn't just teach him how to make money, it taught him how to think about money. And this brings us to the first rule. Rule 1, Mr. Market, don't let emotion drive you. Graham introduces a character called Mr. Market, an emotional, moody business partner who shows up every day offering to buy or sell shares at wildly different prices. Some days he's euphoric, offering you sky-high prices. Other days he's depressed, practically giving things away. Most investors treat the stock market like Mr. Market, getting carried away by excitement when prices rise and panicking when they fall. But Graham says, don't follow Mr. Market, exploit him. Make money when others are afraid and are willing to sell their assets extremely low. This lesson became Buffett's compass. While the world panicked during the 2008 financial crisis, Buffett invested billions. He bought properties, companies, and acquired large stocks of corporations. Why? Because Mr. Market was depressed and Buffett remembered Graham's rule. But here's the catch. Understanding Mr. Market isn't enough if you don't master the next principle. Rule 2, investing versus speculating. Graham draws a sharp line between investing and speculating. Investing means analyzing a business, ensuring it's sound, and buying it at a reasonable price for steady, long-term returns. Speculating is simply betting on price movements without caring about the business itself. Today, with meme stocks, crypto hype, and fast-moving tech plays, most people blur this line. They call it investing. But really, they're just speculating. Buying a hot stock because everyone else is? That's speculation. Chasing quick returns? Speculation. Graham didn't say speculation is evil. He said it's dangerous when you don't realize you're doing it. Buffett follows this rule religiously. He invests in businesses he understands. Coca-Cola, Apple, American Express, not because of flashy trends, but because the fundamentals are rock solid. But what if you're just starting out? Graham had a surprising answer for small investors who don't want to become experts. Rule 3, the defensive investor and indexing. Graham divides investors into 2 types, defensive and enterprising. Defensive investors want safety and minimal effort. Enterprising investors are willing to put in more work for potentially higher returns. The defensive investor wants safety, invests mostly in bonds and index funds, keeps it simple. The enterprising investor is willing to put in hours of research to find undervalued companies. The danger: most people think they're enterprising, when really they don't have the discipline. Buffett himself says most people are better off being defensive, buying index funds regularly, and ignoring the noise. Graham knew most people don't have the time or temperament to analyze companies. For them, he suggested a defensive strategy, simple diversification. That's even decades before it became popular. For defensive investors, Graham recommended simple strategies like dollar-cost averaging into index funds. Buffett still recommends this today. In fact, he told his own family to put 90% of their money in a low-cost S&P 500 index fund and 10% in treasury bills when he's gone. Why? Because most people will beat themselves before the market does. Buffett has echoed this advice countless times. Most people should just buy a low-cost S&P 500 index fund and hold it forever. It's boring, it's not flashy, but it works. Graham's wisdom was simple. If you can't dedicate your life to studying businesses, don't pretend. Protect yourself. So why is this the most ignored rule today? Because nobody wants to be defensive. Everyone wants quick wins, instant profits, and flashy success. But Graham and Buffett both understood. The real wealth is built patiently, defensively, and with discipline. But Graham also warns about a trap that destroys both defensive and enterprising investors alike. Rule 4, the margin of safety, Buffett's North Star. This is the golden rule and the one most ignored today. Graham calls it the margin of safety. It means you never buy a stock, a business, or even a house unless it's priced well below its actual value. Think of it like building a bridge that can hold 30,000 pounds, but only allowing 10,000-pound trucks on it. That safety margin keeps you alive. Always, but at a discount. Never buy anything at a premium. Except you're a rich Nepo baby though. You can whatever. You want it, you got it. Just kidding. So Buffett says this is the most important lesson he ever learned from Graham. It's why he never chases hot stocks or gambles on hype. Instead, he waits patiently for moments when great companies are selling at a huge discount, giving him both profit potential and protection if things go wrong. Here's the truth. Most investors ignore this rule because patience is hard. They want quick returns, not long-term safety. Buffett has proven that without a margin of safety, you're not investing, you're just speculating. But Graham didn't just warn about buying too high, he warned about something even bigger, your mindset. Rule 5, the investor's worst enemy. Graham's last rule is brutal but true. The investor's chief problem, even his worst enemy, is likely to be himself. Fear, greed, impatience, overconfidence. These destroy more wealth than recessions or wars. Buffett has echoed this for decades. He says investing is simple but not easy because you have to control your emotions. During crashes, most people panic and sell at the bottom. During booms, they chase bubbles. Graham taught Buffett to be the opposite. Be fearful when others are greedy and greedy when others are fearful. That discipline, more than intelligence, is what separates great investors from average ones. So let's recap. Mr. Market is your servant, not your guide. Margin of safety is your bedrock. Know the line between investing and speculating. Be honest about whether you're defensive or active. And above all, conquer yourself, or the market will conquer you. Benjamin Graham gave Buffett these tools, and Buffett used them to become the greatest investor alive. But the tragedy is, most people still ignore the most important rule, the margin of safety. If you want to go deeper into Graham's wisdom, pick up The Intelligent Investor. It's not a fast read, but neither is Building Wealth. And if you found this helpful, hit subscribe and let's keep learning how to think like the masters.